Hey everyone, welcome to this episode of In the Money with Amber Kanwar. Today, of course, has to be all about tariffs. I don't even really know where to start because the tariffs that I know are going to be in place, that is 25% on all Canadian goods, I don't know if they're going to be in place in 24 hours, 48 hours. I do know that the markets are roiled by this prospect. Producer Jillian is here. How do we start a news show when we don't know if, when this airs, the news might be totally stale?
Yes, it's really hard. It's really hard. And I think, it just speaks to the volatility that comes along with Donald Trump. In my experience, producing live shows in his first administration was, very stressful, specifically because anything can change on a tweet. The market can fully shift. He could back down. He could, make the tariffs even worse. So it's really hard to say.
Or they could disappear altogether.
Exactly.
So we're going to try and do a show maybe based on all of those probabilities. We've got Barry Schwartz. We're going to talk about how an investor deals with all of this headline volatility. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Barry Schwartz, thank you so much for joining me in studio.
Thanks for having me.
And you have your own podcast.
Yes, long-term investing podcast with Baskin Wealth. We've already done probably 75 episodes, and it's growing. And hopefully, after your listeners listen to me today, they'll listen to my podcast going forward.
75. This is only our 7th episode, so
Mazel tov.
We'll dare to dream that we can get to 75. So good to speak with you. You run nearly $3 billion in money, and of course, we're going to talk about tariffs. I don't know what form of tariffs, because we're talking about them on a Monday morning and it could look very different on Tuesday.
Yeah.
But let's just put your investor hat on. You've kind of seen this before. You've seen episodes like this before where there's so much uncertainty. The knee-jerk reaction is sharp selling pressure. How do you as an investor approach this as a disciplined, long-term, value-oriented investor? What do you do with events like this?
Well, I told my traders to buy this morning. So we have a buy list every day of things that we're excited to buy. And we like to buy things that are down, unlike maybe most investors that want to sell things when they go down. And so we use it as an opportunity because, in our opinion, this is not a permanent impairment of capital. This will be a temporary issue. I don't know how long it's going to last. None of us know. But at some point in time, these tariffs will be taken off and things will recover and everybody will love each other again. And the stocks that we buy today will work out really, really well in the future.
But what if it doesn't? That's the concern, is that this is a different era that we're entering. And it's not temporary tariffs. Yeah. These next 4 years are going to be filled with these kind of targeted attacks.
Well, it's always going to be something with this administration, and it's always going to be something with the market every single time, right? All I can tell you is markets are excellent at adapting, and we'll figure it out. And we'll figure out what the winners and the losers will be, whether or not we adjust how we buy things, how Canada imports stuff, exports stuff. I can't figure that out in the short term. The market tells you today who are the winners and the losers, right? You can easily see names like Bombardier and BRP, Stella Jones, CP Rail. All those names are down, and they're down hard today. But eventually we'll figure it out. Tariffs are not a destruction to the economy. This is not the great financial crisis. This is nowhere near as bad as what happened during the pandemic. There'll be implications, but like I said, I believe firmly that companies will adjust and we'll move on from there.
So it's so interesting you say this is not a destruction to the economy, because a lot of people are brushing up on their 1930s history and remembering a time where the U.S. took a similar approach, tariffing, and actually it was destructive for the economy and was a catalyst for the Great Depression.
Absolutely. And I'm not here to say that this makes any sense to any of us, because it doesn't. It's absolutely stupid. But the bottom line is every economy has different variables and there's going to be different impacts. Maybe if this goes on longer, there'll be significant tax cuts in the US and Canada. Maybe the Canadian dollar will drop a lot. Maybe there'll be widespread stimulus by the Canadian government to help those suffering as well as in the US. It all seems so dumb, but this is the world we're in today. And no question, things are going to change. The market is smarter than all of us. We saw on Friday, right? We were having a good day and the market started to fall. We saw a lot of the companies that are going to be affected by tariffs, their stocks haven't done well recently. So this doesn't come as a huge surprise to the markets. It's a little bit of a surprise at how much some things are already down. But, the bottom line, just like the pandemic, if earnings are affected by this for a year, that only represents 3 to 5% of a company's value. So stocks should be down 3 to 5%. If they're down more than that, and even though the earnings continue to grow, huge opportunities to buy companies.
So it's interesting that you, on day one of a market reaction, you say, let's get out there. You don't want to wait for it to settle down. Wait for a 10% pullback. Wait for things to, get that official correction, as they call it. The TSX is still only a couple percent away from an all-time high.
Yeah.
It certainly hasn't fully priced in this.
TSX is near an all-time high for good reason. The earnings have been very, very good in North America. And we always have to keep in mind that the stock market doesn't necessarily represent the full Main Street, right? There's companies on the TSX that going to have zero impact by tariffs. So what I would say is this. None of us know what the stock market's going to do going forward. None of us know if Trump's going to wake up tomorrow and say, haha, it was a joke on all of us. Or I've spoken to Trudeau and Trudeau said he's going to solve the fentanyl problem and no tariffs. None of us know. So all we know is the current price of the companies that we own. We all expect that this is a temporary issue, and if there's a stock that you wanted to buy and it's down significantly more than what you think the impact's going to be from the tariff, you should buy that company.
How do you think about the Canadian dollar and how that creates a wrinkle in your view, that earnings can continue to grow? The Canadian dollar at one point in the last 24 hours hit the lowest level since 2003.
Yeah. How do I think about it? Well, the good news for our clients is I'm like close to 80% owning US companies. And most of the Canadian companies that we own are essentially US companies in disguise. A lot of them are Canadian companies like Constellation Software or TFI International or Couche-Tard that generate most of their business in US dollars. So for our clients, we're not hurt too badly by this. And if the Canadian dollar goes down, it actually makes the value of our U.S. stocks worth more.
That is a tariff trait, right? Yeah. Like that, you are positioned. You're not totally agnostic to what's going on. So you are positioned for, the long-term effect of this is like more and more exposure to the United States. Yeah. What has that evolution been like for you, weaning off of Canadian stocks and going all in on the U.S.?
Don't get me started on that. So for us, years ago, we decided to pivot our portfolio to owning what we call compounders, companies that have competitive advantages, companies that can reinvest their cash flows at high returns, companies that have recurring revenues, have low capital expenditures. That's where we thought the opportunities were. And so the bottom line is we put a lot of money in our portfolio into higher quality US companies. And that's where we've been pivoting and positioning for a very, very long time.
The pushback to that is you're paying up for it. Yeah. The market in the US is expensive. Yes. And there's a value opportunity. And I know you love your value. Yeah. There's a value opportunity, and the dividends are higher in the Canadian markets. Why doesn't that lure you?
I think the TSX is not a very good index, right? It's very, as we know, very focused on a lot of financials and utilities and very limited exposure to some of the best tailwinds the world has, right? AI and robotics and automation and digitization. We don't have any of that. We have Shopify, we have Constellation Software, and that's really it. So when I look at US companies, I just find so much better business models, right? The internet has changed everything. We just haven't, many people have figured out, right, that these high-tech companies, these big tech companies are global platforms and can sell their products and services not just domestically, but to billions of customers around the world. And Canada's behind on that. So I don't have enough good companies to buy for our portfolio. in Canada to own. There's just not enough compounders.
So what are you avoiding?
Canada. Really. So our strategy, our focus is not to own dividend paying stocks. I think a lot of Canadians are heavily focused on dividends. Yeah, I see you're raising your eyes like, what are you talking about?
They love their bells. They love their bank stocks.
Yes, but here's the thing. Most of them are very, I'll say, bad businesses, or at least mature businesses. Why? Because there's no growth. They're not focused on the right tailwinds. They're paying out all their cash flows to their shareholders as dividends. So a compounder is a company that has the ability to reinvest its free cash flows at high rates of return. The telcos, the utilities, the pipelines, they don't have the ability to reinvest those cash flows at high rates of return. And they have no excess cash flows anyways to begin with, because most of the money has to go to either paying down debt or to shareholders as dividends. So our focus is to not own a bulk of those companies. I think, the biggest returns that you're going to have in your portfolio are companies that can reinvest cash flows at high rates for you. Constellation Software has been reinvesting its free cash flows at 30% a year. So that's why the stock has tripled every 2 to 3 years. It's simple math. Yet people want to get dividends because they're tangible. It feels good. But of course, if you bought Bell Canada for its dividend, ouchie.
Yeah, big ouchie. So you do like Constellation Software, and that, I guess, would be one exception in the Canadian market in terms of tech exposure.
For sure.
One thing you mentioned was about, the nature of how Canadian business is, it's protected. Most of our sectors are protected from competition. The banking sector, the grocery stocks, the telecom stocks, the airline stocks. And so sometimes people love that. They say, well, it's an oligopoly, it's protected. I mean, one of the things apparently that came out of this Trudeau-Trump phone call is Trump saying, hey, I want my U.S. banks in Canada, because Canadian banks can go all in the United States, but they are limited in how far they can come in Canada. Is that a big threat as part of this trade war, that Canada is forced to compete?
I think so. I think the bottom line is he wants to force Canada to be more open and to conform to the U.S. rules, and probably we have no choice at the end of the day. But is there competition in the telcos and the utilities and the pipelines and the financial services because of the U.S. could come in? I have no idea if we're going to change the laws or rules or regulations to do that. But I think that, definitely there's risks to those companies. Canada's been, as you said, very protected in a lot of areas, right? Of course, we've had U.S. companies try to come into Canada and fail miserably, right? The Targets of the world, although Costco and Walmart have come in here and absolutely crushed it. So it remains to be seen what will happen there. I'm not too focused on that. Doesn't really come into my mind. We own one Canadian bank for our clients. Like I said, we're not too Canadian focused. National Bank.
Oh, well, that's been great for you.
Yeah, it's been the best performing Canadian bank since about 2000. And, unlike a lot of other Canadian banks, the CEO was there for many years, Louis Vachon. He ran the company for, I think, 11 years, a long-standing president of a bank. Great capital allocation. They've really made smart moves moving into wealth management. I'm really excited about the acquisition that they made of Canadian Western Bank.
There's a new CEO now.
There's a new CEO, and I think they've done a good job. One of the things that I don't understand that why they have it is a Cambodian bank. Yes. Yeah, it's kind of weird. Yeah.
That's always been sort of a national bank thing, is over the last couple of years, you'll get this ugly surprise from an area of the world. You're like, I didn't know National Bank was there.
It's actually been a terrific surprise, because the return on capital, the investment that they've made, I think they put in a few $100 million, and it's probably worth a couple billion. So it's been a huge return for National Bank, and Cambodia is a growing economy, but there's always risks when you go into these emerging markets. Anything can happen.
You know what's interesting? You mentioned National, because maybe 10 years ago, maybe less, it was one of those stocks that nobody wanted to touch. That was low valuation, maybe high dividend yield. Yeah. So how did that break through for you? Because as you said, that's not typically what you're looking for. Yeah,
so I would say that we were very heavily focused on Canada up until about 2012, 2013. Listen, these companies, the Microsofts and the Apples and the Googles, they existed, but they weren't in the form and fashion that they are today, up until 10 years ago, right? Things have changed so rapidly that we wanted to get exposure to those type of businesses.
Don't you worry about concentration risk, that you're just too exposed to tech?
I think I'm probably underweight tech, to be honest with you. I think, what is it, about 40% of the S&P 500. We own 5 of the Magnificent 7. Unfortunately, we don't own NVIDIA or Tesla, 2 of the best performers last year. I think our clients are underweight that if we're using the S&P 500 as a benchmark for Baskin.
Why are you underweight? Yeah, NVIDIA and Tesla.
Why don't I own them?
Yeah.
Can't own everything, never researched them. One of the things that worried us about NVIDIA is it's really a commodity type business, right? It's just that they figured out AI so quickly and so much faster than the competition, and the growth has been so tremendous. And that was an area that we really like to own more recurring revenue businesses, things where it doesn't innovate as fast, but completely missed that. Tesla valuation was never like we even though we will pay up for growth, no question. I could never get around paying 150 times earnings for it, and that's been completely wrong.
Well, at least you can admit it.
Yeah,
I think that's the beautiful part. Okay, we're going to dip into the mailbag here. Questions for Barry Schwartz. Barry, speaking of how fluid this whole situation is, as you're talking, we got developments with Mexico where it looks like, okay, after all, maybe they're not going to go ahead and tariff Mexico. In the near term, it confirms a 1-month pause on Mexican tariffs because they've come to an agreement on something related to fentanyl. Yeah. So that's happening now and speaks to this insanity. And let me just look at the markets now. A little bit of a recovery. Maybe we finish in the green today. I don't know. I mean, how wild, that's so much work.
That's my point when you asked, what, don't you wait for things to settle down before buying? And the answer is no. No, if you believe in the company, if you believe in the long term and the market gives you an opportunity, you got to go ahead and take it. This morning, National Bank stock was down 7%. Why? It has even if there's tariffs, there's no impact for National Bank. It sells services, not goods.
So the concern is what it means for the Canadian economy,
yes,
right? That is real, and the banks are right in the eye of the storm with that.
But you have to look at how much is it. Should it be down 1 or 2%? Sure. Should it be down 7 or 8%? No, that's an opportunity. So that's the judgment you have to make as an investor.
Yeah, and it's coming back already.
Yeah, so we don't know what's going to happen tomorrow, right? Trump can wake up and say, okay, Trudeau, I'm going to offer you the same deal, fix the fentanyl thing. Maybe this whole tariff thing was really about fentanyl, and no idea.
Not about the milk, not about dairy, not about anything else. No. Is there a chance that that's actually true?
I don't know. He probably heard from everybody that this is the stupidest idea you've ever come up with, and look at the impact that's going to happen. Look at the stock market was killed already. So
I think he knows that, right? And it's just all about making a deal. The concern was we didn't really know what's the target. Yeah. What can Canada do? They'd already kind of committed to do more on border and fentanyl, but still they went ahead with these tariffs. This is supposed to be our friendliest neighbor.
And it doesn't solve any problems, of course, with the uncertainty of what that the administration can come up with next to worry us, right? And so I think our listeners, investors, Canadians need to recognize that this type of uncertainty is what happens in stock markets. You tell me the last 5 years, were they certain? Come on. So this is just the way it is. And that's the price you have to take for being an investor and trying to earn better returns than getting 3% on your GIC.
This is your North Star then. You're just looking at companies and you don't really care why they go down. If you still like the company, you're in.
I care why they go down, but no.
Sorry, if they get
my North Star is to be a long-term investor, is to I own 40% of Baskin Wealth. Nobody's going to make me sell that for a dumb price because I know the future of our company and how well it's doing. Why would I sell shares of the greatest businesses in the world? Because of volatility. It makes no sense. You can own Apple and Microsoft and Google, the best franchises the world has ever seen, and they go down because you're worried about some Chinese AI thing. That's the opportunity. If they get disrupted, if their businesses start to go down because there is competition, then you have to decide whether to own them or get rid of them. But for these crazy events that come out, most of them are buying opportunities, if not all.
All right, well, let's see if we can talk about some of these stocks and dip into the mailbag. Okay, Barry, our first question is from Darcy. Adobe is down 30% over the year. Do you still like the stock?
Well, I'm not happy with it, and this is one where we haven't made any money on the stock. We started buying it around about $400 in 2022. The stock had pulled back significantly, and we thought, well, this is one of the best businesses in the world. It sells, as you know, editing tools and makes a ton of money. I think has gross margins of close to 90%, raises prices every few years. And with the proliferation of Instagram and TikTok and online social media, you need a lot of these editing tools. But the stock hasn't done anything. In fact,
isn't there concern about OpenAI and the proliferation of what that can do to their business?
Absolutely. So there's the worry that there's other alternative tools, whether it's Canva, which is a competing product to Adobe, or Midjourney, or OpenAI, Sora, these type of text to prompt to text type editing tools and imaging creations that could get rid of Adobe's business. I see it opposite. I see it as Adobe has the best distribution in the world, and people will trust Adobe's tools to make and use editing for creative going forward. I think Adobe will be the leader. So the stock is trading at around 25 times earnings. It's not overly cheap, but for a company of this high quality, it guided for double-digit top line and bottom line growth. Organic. This is not a company that makes acquisitions. It grows organically by raising prices and adding more seats, more licenses. We're very excited about it. I think the new developments in AI, making it cheaper, making the fact that the distribution could increase dramatically, is very beneficial for software companies like Adobe. So we see it as a big opportunity, and we're not selling the stock at all.
All right, trading at around a 1.5-year low, and Barry would buy it here. The thing about having a following is people typically know what stocks you talk about, what stocks you like.
I've gotten nasty phone calls, nasty emails, only about the losers. No one ever sends me a nice email about the winners that I've recommended over the years on BNN or what have you. But whatever. No one forgets your losers. They still beat me up about Home Capital.
They still beat. Well, that ended up winning, right?
Not for me, but
not for. All right, that's fine. Let's see if we can find some other winners. I don't think this next one is it. This one is from Doris, and I bet you got a lot of calls on Vail Resorts.
We sold Vail Resort actually last year.
That's right. So Doris wants to know why you did that, because she recalls that you were quite bullish, quite optimistic at one time. And I guess if you got out, that's good, because the stock is really struggling.
Yeah, well, so we sell for a number of reasons. We don't sell because the stock price goes down. Generally, we sell because we found a better opportunity, or we think the management, the current company is not doing a good enough job, or the fundamentals are not going in the right direction. The last 2 years, 2023 and 2022, were not very good for the ski season, right? There was no snow really in the United States. They own ski resorts in Australia. There was no snow in Australia, so it's really lousy. And that's too bad, because coming out of the pandemic, people were looking for a lot of things to do. They also raised prices tremendously, offering this pass for $800 or $900. And if you can only go skiing once, it kind of sucks. What made us sell the stock is the CEO, Daryl Katz, a guy who had been running the business for a long time. He retired, and we thought it was time to exit the stock.
That was it.
That was it. He was an architect of I'm not sure his name is Daryl Katz or Rob Katz, but whatever. He was the architect of bringing the company public from private equity. He had done a great job. He retired, moved on to chairman, and that was the impetus for us to look. And we think we found a better investment idea, and so time to move on.
Yeah, Robert Katz.
Robert Katz. Close. I got his last name right.
It was close. Yeah, there we go.
Off the top of my head.
This third question is about Alphabet. I'm retired and happily collecting dividends from the bank stocks I bought 10 years ago, so we know it's a Canadian.
Yeah.
However, lately I'm finding that I'm missing out on the Mag 7. I recently chose the CDR version of Alphabet, mostly because I believe the Canadian dollar is bottoming out.
Yeah.
I'd like to hear Barry's opinion on this. This is coming from Marcel. Can we take a step back and just explain what an Alphabet CDR is?
An Alphabet CDR is a product that allows you to buy Alphabet without having any currency risk, right? So you're buying it on the Canadian Stock Exchange, and you're buying it. You're not actually owning shares of Alphabet. You're owning shares of an Alphabet CDR. I hate I hate products, by the way. I'm not a product person. I don't like buying anybody else's product. And there's a fee that's attached to buying this Alphabet CDR. I think you're paying 50 or 60 basis points, so almost 0.5% to get rid of the currency exchange. As a long-term investor, currency is meaningless, right? If you're planning to hold a company for 5 years, 10 years, I don't care if the Canadian dollar goes up 20% on me or 10% against me, right? Because I'm hopeful that I'm going to compound returns at double-digit rates on the stock that will make the currency risk meaningless.
So you wouldn't buy the CDR. You don't take a view on currencies when you're buying stocks like this. So then in general, how do you feel about Alphabet?
We love it. We've owned it for probably since about 2011, 2012.
So you're up and happy.
Up and happy. And I do think it's one of the best businesses the world has ever seen. I don't have, they are into so many exciting areas, right? Cloud computing, hyperscaler, the YouTube business is phenomenal. And the search business, yeah, it's going to face some risks from OpenAI and other chat products, but it may also lead to more searches. In the meantime, there's been no slowdown in the search business, and the stock is trading at quite a reasonable valuation, in our opinion.
More than reasonable. It seems like it doesn't get credit for. So like we talked about Tesla, and you said that insane multiple that it's trading at. And part of the reason Tesla trades so high is because they're going to have robo-taxis.
Yes.
Google has robo-taxis already, and it's expanding through Waymo. Are they getting credit for some of these other things that maybe are germane to search, but they're meaningful on their own?
Google has way more than Waymo. It has DeepMind. It has its own GPUs, TPUs, they call them.
Semiconductor chips.
Yeah, they're and spending billions of dollars every year throwing out the window on other things that we have no idea what they're building, right? So, I think Tesla is a cult stock right now. Yes, you can do the math and say if everybody has a humanoid robot from Tesla in their house and a robo-taxi and this and that, maybe it's worth a fortune. But guess what? All the other big techs are going to be doing that too. Are you going to trust a Tesla humanoid robot or an Apple's humanoid robot or a Google one? They're all going to have the same exact products. So here's the thing. I'd rather stick with companies that are making a fortune today and throwing some money on the side to try and make money on exciting products, but I'm not betting the exact company. I'm not betting the farm on that growth. I'm making a ton of money already on Google on their current business, and if things work out on some exciting things they're working on, stocks continue to do well.
You don't think their search business is vulnerable to these chatbots like ChatGPT and DeepSeek?
For sure. For sure it's vulnerable, but look at like you just said, it's trading at a reasonable valuation, right? It's not trading at 100 times earnings like Tesla. It's trading at 25 times earnings with a beautiful balance sheet. So I think some of that is already reflected in the price of the stock.
All right, we're going to take a quick break and dip back into the mailbag. We'll be right back. And we're back. Our next question is from Dave. Do you believe Canadian Pacific, Kansas City, I wish they'd change their name, but CP Rail will outperform the S&P 500 over the next decade?
No idea. That's crazy.
Hey, you're a long-term investor.
Yeah, I don't know if it's going to outperform the S&P or what, but I do think it's going to do very, very well after we're done with the tariffs. It's been the best run railroad in North America for years. The operating ratio, the efficiency ratio has been incredible. They have one of the best CEOs in rail, and it's there in the stock price, right? It's trading at a premium to all other railroads. Maybe not so much today. I think it's probably getting hurt a little bit because of the tariffs.
Yeah.
The CPKC acquisition should work out tremendously, especially if Trump is going to get his way and see more onshoring and manufacturing in the U.S. If there's more onshoring in Mexico, has to work out great for CP. I like the company.
Like it?
We like it.
it's flat for the last year, so it hasn't done anything, which I guess is better than CN Rail.
Yeah, we used to own CN. We actually sold it last year. That was been a very poor investment for our clients.
Would you switch or you'd stick with CP? Like there's been so many upgrades on CN Rail just because it's so cheap. It's so rare that you're able to buy a rail that cheap.
Amber, if I was smart, we used to own CP, the conglomerate in 2000, right before it broke up. Should have never sold any of it. And we got scared. I don't know why we got scared. We got scared when Bill Ackman first came in and tried to shake up CP.
Oh, that was a mistake.
Yeah, it was a huge mistake. We had it like the stock went from 60 to 75. We're like, yeah, that's good enough. And now I think the stock is split a few times, so it's gone up 5 times from that. So selling good investments that are where the fundamentals are growing has always been a mistake. So yeah, we'll take a look again at CPKC at some point in time. It's a great business, but it's not like a fast growing business, GDP type business with a little bit of upside on pricing. But where they excel is keeping their costs low. They know how to benefit from cost controls, and we're long-term bullish on Canadian resources, U.S. economy. So I think CPKC is going to be long-term.
Because you don't really have a lot of those investments.
Not now. Okay. Things can change.
Things can change. Another one that I feel like is synonymous with Barry Schwartz is CCL Industries. Yeah. We actually got a couple questions on this, and I think investors are getting nervous because over the last couple of months, CCL has been under pressure. Would you add more here? Do you still like CCL Industries? And what is so sexy about this company?
It's sexy.
It's labels, right?
It's labels, but labels are on every. They're the world's largest label maker, right? And when you open up, Kraft Heinz opens a ketchup plant somewhere and wants labels, CCL opens a plant next to it to send the labels. It's an amazing business. They're great operators. It's a company that has demonstrated the acquisitions that it's made and had high returns on those acquisitions. The thing with CCL recently is it hasn't made a lot of acquisitions. So people are kind of waiting for the company to do something. It did have a very good 2024. Organic growth picked up tremendously, but people are now worried that that's going to slow down. And if there's worries about a recession in Canada and US because of tariffs, then that may be impacting the stock. But it's not a tariff loser. It's not making its labels in Toronto and sending them over to a plant in Kansas City. It actually has plants next to its customers in each country. So no impact from tariffs to the best of our knowledge.
Okay, our last question in the mailbag is about Live Nation. Yeah. I think this is one of your favorite businesses. I hear you talk a lot about it. Maybe not for those trying to get concert tickets, but as an investor, you love it. This year says Love Barry. Love Barry, I sold Live Nation too soon. Does he still hold it?
I bought this for my wife during the pandemic, and I do.
And they say romance is dead.
Yeah. So I bought this for my wife, and she said, "Why did you buy this? No one's going to go to concerts anymore." And I said, "Yeah, but the stock is down so much." And so I think I bought it for around $20 or $30. It's now $140 a share. So she doesn't question my stock picks anymore. We love the business so much. It really is a fantastic 2 businesses, right? Ticketmaster and the concert business. It gets so much flack from everybody. But what I think Live Nation does is it says to its artists, we're going to take all the pain and punishment. We're always going to be the bad guy. We're going to make you look like the good guy. But the bottom line is Taylor Swift and her management set the ticket pricing, not Live Nation. They decide how much they should charge. And if Live Nation comes across as looking like a bad guy, so be it. In the meantime, the stock price has gone straight up, even though there's worries about antitrust, the company being broken up. I'm like, hey, break it up. It'll be worth even more because of businesses.
So you're not worried about the U.S. government saying you got to get rid of Ticketmaster. It's a monopoly.
No,
you'd still hold.
I think separate companies that could be worth even more. So there's no even if you break it up, it doesn't get rid of the businesses. It's not like, and there's no competition. If you wanted competition, if you want a business that's a pure monopoly, unfortunately, this is it, because no one has the technology, the relationship with the artist, and now it's acquiring so many venues. So it's a vertically integrated business, and the valuation is still pretty attractive in our opinion.
All right, now it's time for a look at some of Barry's pro picks. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, these are your 3 best stocks that you think could really outperform over the next year. We've got Barry Schwartz with us. Your first one is Apple.
Yeah.
I like this pick. Tell me why.
Because everybody on FinTwit hates it. Every time I tweet about Apple and how much I love it, and Apple is the GOAT. It is the best like when I say best businesses in the world, it's Apple, right? It sells a product that we cannot live without. Or if my kids lose their phone, if they can't find the AirPods, there's holy hell to pay in my house. My wife lost her phone for an hour. She was ready to get in the car and go get a new phone. That's how addicted we are to those products. 1.4 billion users of iPhone, 2.35 billion users of Apple products. So distribution is what matters. Over time, we're going to see them selling more products and services. And now that all the tech bros are in bed with Trump, there's going to be no stopping in terms of, in our opinion, what huge markets that they can get into. So stock is pulled back, worries about China tariffs a little bit, maybe some tit for tat on China that could impact Apple. But we think for the best business in the world, if you think about it, the valuation is quite reasonable. If you look at it as just a normal business, 30 times earnings, quite expensive, but you shouldn't think about it like that. This is a Ferrari. This is a Costco. This is a company that is going to be getting into so many amazing areas. And if AI becomes cheaper, the proliferation of it, your smartphone can now be, like an AI producer, right?
I'm waiting for Siri to get a brain. I want her. I'm ready to make it work with Siri. So let me capture what FinTwit is probably saying to you. Despite all that amazing stuff, it doesn't grow very much. And it is struggling in China, which is an important market. And that major thing that everyone is excited about, artificial intelligence, it is not there.
Early. So it's early days for all of that. The AI hasn't even done very much for anybody yet. We're expecting 20% earnings per share growth this year over year in Apple, and then double-digit growth from there. Where is that going to come from? That's going to come from launching new products and services. One thing that has been talked about.
Like what? But beyond the phone, what else?
More services, financial services, healthcare services, more subscription stuff to come. You just don't know, right? But no question, once you have 2 billion plus users of your products, they're going to be selling you more stuff.
The reason I was challenging you on the like what, because we know it's not the car, so that's officially been shelved. We know, I don't know, is it goggles? I really don't.
Yes, it's of course. Apple's going to wait to see how Meta does with its Ray-Ban goggles or glasses and then break into the market. Apple will wait to see how Tesla does with the humanoid robots, then copy it, and because they have the distribution. This is all that matters. People forget all that matters is having those captive users. And even though China is not growing, the rest of the world is growing tremendously. One point I was going to say is Apple has latent pricing power. There's opportunity to raise prices on those phones. It hasn't for the past few years. So what we see happening, Amber, is a little bit of pricing power, a little bit of growth in its markets, adding more services and products. You can see this growing at 5 to 7% on the top line or organically, and you can see double-digit earnings growth. Don't forget, it's buying back 2 to 3% of its stock every year.
All right, so we've got the bull on Apple. Your second choice is Microsoft, and this one has been a darling for some time because it's in AI, but actually, over the last year, it hasn't really done much.
So that's why I'm coming to you with a picks that I think have opportunity. So Microsoft, as you know, it's hyperscaler business growing at 30%. I think it had 150% growth on AI in the quarter. So this is where the growth is going to come from. It can't build enough data centers. This is not like it's building data centers where there's nobody's going to be using it. They're sold out, right? So we see this as a top line grower, double digits, bottom line grower, 15% compounding for many, many years. And it's a 5-tool player. It's in all the best areas of growth.
What does it tell you when the market is not giving a stock credit for that? Because as I said, it hasn't done anything in the last
So the valuation is not like it's 10 times earnings. It is trading around 30 times earnings. So I think the market is giving it some credit for that. But I'm a simple guy. If I can get double-digit earnings growth over the next 5 years from a company, that pretty much means the earnings per share should double. And if the multiple stays the same or falls a little bit, I should get some pretty good stock return. That's how I see it. I want to own companies that grow faster than the S&P 500, that I'm not paying an enormous multiple for, and hold them for at least 3 to 5 years. And if I can do that and find a great, more than my fair share of winners, well, my clients are going to do very, very well.
What about in Meta? Clients have done very well in Meta. You continue to add here.
I love the fact that Zucker, what is he, 41 years old? Okay, this guy is worth what, $300 billion, $400 billion? He can do anything he wants, yet he goes to work every day for you as a shareholder to try and make you more money. And this is the make or break year for its Reality Labs, which is so this is our thesis. We think that at some point they're going to stop this Reality Labs nonsense, and that could add about $150.
You think it's nonsense?
It's nonsense. And I think that could add $150 to the share price because they're losing $6 a year of earnings on Reality Labs.
So they ditch Reality Labs, and then what? It's just like an ad business, or then they're getting the incremental torque from AI? Because that's one of the few places that I actually do see AI in real life.
Oh, for sure. And it's totally working. And this is a business where advertisers can see what's working and what's not working. And in the last quarter, the advertisers are paying up for advertisements that include AI. So it's only going to get better from here, right? We can imagine targeted ads so specific to you and I that it would be shocking. And Meta says that you're not even going to need an ad agency to create an ad. We can just do one online for you in 2 seconds using AI. So in the meantime, as you know, Amber, they're in WhatsApp, which is growing tremendously. There's lots of opportunities to monetize
Threads?
that.
I thought Threads was dead. And then they're like, oh, there's several hundred million. I'm not on Threads.
Neither am I.
But apparently several hundred million people.
325 million daily users of Threads. No idea.
I had no idea. I didn't believe that number when it came out.
That's another one where the valuation, 25 times earnings, beautiful balance sheet, similar to Google. We think these are inexpensive stocks. I know it sounds ridiculous to keep recommending the Magnificent Seven type names, but these are the amazing businesses growing at still high double-digit rates of return that are into the best tailwinds the world has ever seen, which is AI. AI could be an absolute massive game changer. Why are these companies spending $300 billion next year on data centers? Do you think they're all morons? I don't think so. I think they see the opportunity as just absolutely life-changing. And so that's why we want to have exposure to those companies.
People will bring up the 2000s when Cisco was building up they overbuild. And they over-anticipate the demand. Isn't that a risk?
Absolutely. Could happen. But like I said, if it doesn't happen, these companies are still making a fortune on their core businesses. AI is additive. It will be tremendous, but it's not like Microsoft or Meta or Google or Apple are trading at 1,000 times earnings, right? If we look at the dot-com bust, if we look at those JDS Uniphases and the Nortels, that was complete baloney. Those companies were trading at 150, 200, 300 times earnings, no growth, no profits. It was all BS. This is the opposite.
All right. Before I let you go, there's a lot of people who talk about Reddit maybe having the best potential of following the Meta playbook in a way that other social media hopefuls like a Snap or even Twitter can't do. Do you think Reddit has that potential?
I haven't studied it, so I'm useless for you on answering that one.
All right. Well, no worries. You've been very useful the whole show, and I appreciate your time, Barry.
Thank you so much.
And as a little gift, because I know you love to collect swag, you can keep that in the money mug.
I was so hoping you would offer that to me. Thank you so much.
Yeah, don't say you never did anything.
Put it right on my desk so everybody can see it.
Thanks so much to Barry Schwartz of Baskin Wealth joining us. Make sure you tune in to our next episode. We've got Martin Pelletier, Senior Portfolio Manager at Trivest Wealth Management, joining us, taking your questions on pretty much all North American large caps, and he'll probably sprinkle in some politics as well. You can get your questions in anywhere on social media at In the Money Pod. You can send us an email at questions@inthemoneypod.com or visit our website, inthemoneypod.com. Thanks so much, and we'll see you next time.